Oops. So that's it. Recording is on, and we can start now. So good evening, everyone. I'm back again, and I'm very happy to work with you again for this new session, which is session number 5. And just to start with, first short summary of what we did yesterday, short presentation of what we will do today, and then perhaps a few words on other business like the presentations at the end of the course. It's your group assignment, and then we start with the cases. So if you remember what we did yesterday, we had several goals. The first one was to extend the analysis of the strategy and financial policy of this group, which is BSN Danone, up to first the middle of the 90s with the presentation itself, and then with a few more slides up to now, let's say 2020. The second point, was really to introduce another case, which is the case you find here, and trying to make a short presentation of the case itself and the products and the issue, and all the principles of vision, principles of management, which are on slide 3 and are 3 mainly. Then I was just at the time, at the end of the course, we should start with the next slides, and the next slides are here. We're here, and now we are here. It means with the financial problems behind, and with the schedule and working organization. So you had, if I come back to the beginning here, you had the title, 1, 2, the table of content, 3, the vision, 4, specific circumstances, haste and flexibility, then the issues in terms of market share, the companies involved, 5, okay, and we were at that stage at the end of the presentation. So I will go further, of course, with financial issues, the organization, the legal questions in the contracts, the financing and market reaction, and then the consequences in terms of integration of several points, and particularly, of course, on financial points. Remember that what we have here is a friendly offer. It's not a hostile offer. I plan to go to the end of the case, and I think I will be at least able to start with another one. You've received already, which is Perrier, which is a completely different case, with hostile offers on 2 companies linked one to the other, both listed on the stock exchange, with 3 main competitors. So this is where we are, and this is what we are going to do. So another point, and you will receive more information with Tram, it's about your assignment. There is no final exam in this course, but you have a group assignment, and you will have by per group, and the groups will not be more than 4 students. You will have 3 presentations, and presentations will be done in the last 3 sessions, which are scheduled in December. Of course, we're already in December, but in a few weeks, and precisely, more precisely, and probably get already this information 21st, 22nd, and 23rd. Okay. So that's what you will have to do. And we start on the 21st with the first set of presentation of the cases. You will receive the cases very soon in order to start your preparation. Now, let's start with the topic for today. And the topic for today, so is that case, which is Nabisco, what I call Nabisco to simplify, And we were here yesterday before starting with financial presentation. So first, before going into the data here, you should understand what's really happened. I said Nabisco is a US-based company listed on New York Stock Exchange. It's a big company, large, with two kinds of operations. The first one in the food industry, with biscuits being the most important segment in the food industry, and the second one in the tobacco industry. If you had to look to the income statements per category of products, per segment, you will understand that the tobacco operations have a better return than the food, and particularly among the food than the biscuit. This company was listed on the New York Stock Exchange, and there was a large float, which means, in fact, the management didn't control the annual meeting, and it was an opportunity for a potential bidder to launch a hostile takeover bid. So, second point, this was done. And this was done by a fund which is very well known, still one of the biggest on the stocks market in the world today, which is KKR. And KKR are for the three associates, which are Mr. Kravis, the president, chairman, Mr. Kohlberg, and Mr. Roberts. And all of them had already a long career. They were about 50, and a bad experience in industry and in the banking sector. And they decided to launch a takeover bid on Nabisco. And my goal is not to describe the takeover bid here, just know that they were successful. So they bought this company and they paid cash for shareholders. And in fact, they didn't have a cash, so they borrowed the cash to different banks in order to succeed in this operation. So that means at the end, you have KKR with large amount of debt, I would say a very high debt equity ratio, but they own 100% of their target, Nabisco. So the question in that case is what to do, what was the financial policy of KKR. They decided first, as we do usually in that case, to look for the cash, and they went into different departments and into financial management of the target of Nabisco in order to find there is some cash somewhere. Of course, they found the cash, but not at a sufficient level to pay the debt pay back the debt and even the interest. So that means the only solution was to sell part of the target of the subsidiary right now. And Nabisco, with its two activities in the food and in the tobacco industry, was a very international company, but at the same time very American. That means they had about 70% of their business in the US and Canada, about 20% in Western Europe, and about 10% in different countries in Asia. So what was decided by KKR, it was to resell the activities in the food business in Europe, and particularly, of course, the one which was the most important one among the activities, which was the biscuits. As usual, and if you have a look to the strategy of many American groups when they have that kind of situation, they keep the operations with the best return, tobacco, yeah, and also the US-based operations, and they sell what is out the US and Canada. So they were decided to sell or to resell the European operations and also the Asian operation. For different reasons, they thought it was better to start by Europe. If you remember what you saw on my slide on the history of Danone yesterday, there was, on one slide, there was the sale of the acquisition of the Asian part later. But here we are in front of the operation of resale of the food industry in Western Europe with the 5 firms I presented yesterday. 3 firms in England, 1 in France, and 1 in Italy. So, and they wanted, of course, to negotiate, to find 1 or 2 potential firms interested in buying the biscuits activities, but they preferred to have a negotiated offer and to negotiate very quickly because they needed the cash. So they wanted to pay behind cash anyway, and speed, cash and speed are 2 elements which are very, very important for them. I'll give you part of the answer right now. Part of the answer is here on that slide. And you understand that the amount which was important for the period of time, it was $2.5 billion. But when you have a look at that kind of data, you have to consider what it means, you know. If you consider the 5 firms on with a sales focus, you understand that the level of sales of Nabisco Europe in the biscuit industry, which is 7,750, is split between the largest part in England, about 2/3 in England, France and Italy. But if you compare to level of sales of BS& Danone at the time, it was about 18%, 17.2 more precisely. That means if you compare to preceding acquisitions made by the group BS& Danone, it was not so large. And they, in terms of sales and operations, it was, something which it was feasible to integrate properly these activities and these firms. So there is no real operation. You have to do it. Of course, you will find the constraints, difficulties, and take time. But to increase the level of sales of a company in an industry which is well known, they already had basis in the biscuit industry for General Biscuits. Remember what we said? It's not a too difficult job. They should succeed. The second point, it's what does it mean now after sales on the net earnings? And you have a look to the next paragraph of that slide. And what you find is a total of 615, which is also split between the three countries, and the largest part is in the UK. And you understand, if you compare the 446 made in the UK to 615 in total, it's about 2/3. And if you compare to sales in the UK, 5,000 compared to 7,750, it's not very far. So the largest part in terms of sales and in terms of net earnings is in the UK. But the total now, 615 is about 24% of BSN sales. 24% of BSN sales. And 24% of BSN sales, it's much higher than the 12%. Of BSN, excuse me, there's a mistake there. Of BSN earnings is 24% of BSN's earnings. So it means the impact on the net earnings of the buyer, the acquirer, is more important than the impact of the sales level. And this is part of the revolution process. It means this will probably, increase very quickly the net earning per share. This is what we can expect. After that, you have a third element on financial resources. How was it financed? It was financed 100% by debt. They had multiple option facilities. It wasn't sufficient. They renegotiate our financial contracts with banks. We see that on the next slide. But anyway, they financed the 2,500 million US dollar paid in cash by debt. And if you compare to the total level of equity of the group, BSN at the time, it was more than 100% of the total equity capital. It is, of course, the group has already debt, but something which was acceptable, something like 30%. But if you increase a level of 30% by 103, it's 133%, which means you are at the end of the process in a situation you have to reduce this level of debt, perhaps to consolidate the debt first, and second, to reduce this total level of debt. So what we understand is that the problem is not at the level of integration of the operations. The problem is at the level of the financial structure, clearly, simply the right side of the balance sheet. And last, and we go into details on that, there is a goodwill. It means they paid the $2,500 million, which at the time is an equivalent of 13,600 million of French francs, with a US dollar to franc currency rate, which is 6.75. And if you have a look to what is in the balance sheet of the companies which are bought, I will take the 5 balance sheet of the 5 companies which are bought by BSN, and you try to find what you paid. In fact, what have you paid? What have you bought? And you understand very quickly that you have paid much more than the difference between the equity on the one side, the assets on the one side, and the liabilities on the other side. So that means either it's bad business, and you have not been a good in negotiation, or it means you have bought something which is not included into the balance sheet, which is the answer, in fact. And this answer is a goodwill. It is something you buy, which is not included in the accounting system. What is it? What is it? It is, of course, made of two different things and two different elements. The first one, the most important one, is the brand. Invest industry. Brands are a large part of the value. It's probably more than 50, 60% of the total. And the other part is made of, for example, for Britain, the group BS&L was not in Britain at the time, kind of right to enter the market. You pay for that. It's like when you go on a motorway and you have a toll. And we paid also for some specific innovation in the production process. So anyway, that means that a large part of the amount you pay is not into the balance sheet and have to be reintegrated in the balance sheet afterwards because you paid for that. This will be one of the accounting questions we have to deal with later in that case. The question after that is what to do with the goodwill. And at that time, you know, BS&L was accounts were presented under the American GAAP, US GAAP, and the rule was to depreciate by 15% by on 20 years the total amount of the goodwill, which means if you go just to the last result, it represents about 15% of the net earnings at the time of the deal. That means just the fact you have bought and paid a company mainly for goodwill means that your depreciation, total of depreciation each year will increase tremendously and reduce whatever it is, the net earning by about 15%. Okay. Now, after this consideration, and you understand that the problem we have to solve, it's partly, of course, a problem of integration of operations, but mainly a problem of financial structure, refinancing of the operation, and after that, probably an accounting problem with the decision about what to do with the goodwill and how to depreciate this goodwill progressively over time, which is a question you find in many industries today, particularly all these industries with brands, cosmetics, food, for example, or in those with large research program, pharmaceutical sector is also part of that. So this is slide number 1 and number 8. Now, two very important elements, and generally you don't find that in the cases, and you never find that in the books. One of the issue here is to speed it, to go fast, okay, to go fast. Why? Because you have potential the potential competition. Competitors could come into the deal. And we have identified these competitors, who are, of course, a British group, United Biscuit, but also other groups like Balzen, the German group, or even Barilla, the Italian. And if you manage your schedule in order to negotiate, organize a negotiation very fast, you have probably an opportunity to eliminate this competition. Second, also because the seller here, because its level of debt, need cash very quickly. So we probably prefer fast negotiation, even if the price is a bit lower than long negotiation with a price 5 or 10% higher. Time is really an issue. So what you find here, it's a schedule of what's happened. And it was a very big operation done in a very short period of time. We start here with on May the 3rd. Start on May the 3rd, and on May the 3rd there was a notification. It means the chairman of KKR, the buyer of Nabisco, said, I want to sell the firm belonging, the department or subsidiary belonging to Nabisco in Europe, and I'm open to negotiations. This is where, of course, if you are a potential buyer, you have to react. And you say, I'm ready to have the first meeting with you. So they had the first meeting, on May the 11th. This is the second line here. Mr. Kravis for KKR and Nabisco, and Mr. Ribou, CEO of BSN Danone on the other side. And what they did was we said, okay, it seems we are interested. We win a few pounds. We'll do that as quick as possible. It will be paid 100% in cash. It will be paid in US dollar in New York City. 2 days at the latest after the signature of the final contract. And it was also said by Mr. Kravis, okay, we are on May the 11th. I want to negotiate, I accept to negotiate only with you up to June the 6th. So that means there was a window for BSN Danone with these constraints on up to June the 6th. And of course, it was clearly a goal to sign before June the 6th to eliminate the competition. So this capacity to react to a notification and to make a proposal which is acceptable by the seller is part of the acquisition process. It's really part of it. It's probably here the most important part. So then what's happened? They were in New York City. Mr. Ribou flew back to Paris. And the first step started. And the first step was a step dedicated to what we call memorandum and studies, on the companies, 5 companies. It was in fact due diligence, if you prefer. It means teams of BSN Danone went to the 5 firms in France, England, and Italy, and had the possibility to study documents, to make interviews, to make some analysis of financial situation. They went there with PricewaterhouseCoopers, and they went into the accounts. But anyway, from May the 11th to what you see the strategic committee on May 29th, the end of this period of memorandum studies and due diligence is a short period of time. You have 5 firms with different countries, and you have to send your teams there. You need your audit firm with you. It's very short. So our due diligence processes always short, or it depends on different factors. The answer is that it depends on different factors. When the markets for acquisition is, I would say, in favor of the acquirer, I mean, you have many firms to sell, and there is no really many firms interested in making acquisitions. Of course, situation is in favor of the acquirer, the bidder, and the bidder asked for long and detailed due diligence. When on the contrary, we are in a period which is in favor of the seller. The seller asks for limited due diligence and short period for due diligence. Here, if you have a look, situation is really clearly in favor of the seller because of the environment and because also of the specific circumstances in the financial situation of KKR Nabisco. So, what's happened at the end of this period, which is very short, it's about 17, 18 days, there's a strategic committee meeting. A strategic committee is in P.S.N. Danone, a committee making the decision to go in the detailed step of the negotiation. It means we are interested. We went in the due diligence process. We get the reports. And now we have to decide if either we just say no, we will not go further, or if we want really to negotiate in details the contracts and the acquisitions. So this is a very central step in the process, So this strategic committee involves, of course, the member of the board, particularly on the large acquisition like this one. Also part of the teams which have been working on the due diligence, and also of the department which is managing the acquisition, merger, joint ventures, and so on in the group. So it's a quite large committee. And here, of course, they decided to go further, and they decided to negotiate. So next step start the following day. And this is quite interesting. You will see some of the details on the next slide, but anyway, it starts on May the 30th, and the end is on June the 6th. And this second step of the negotiation was organized in New York City, in fact, in a hotel. And the teams, when we dealt with all the questions necessary to solve before signing the final contract. It's not very long again. May the 30th, June the 6th, it's a week. So at a point in time, in the night from June the 5th to June the 6th, early in the morning, in fact, they agreed, and the final contract was signed. And of course, the problem will be the problem of notification. Two companies have, two teams have signed a contract, but now they have to notify this contract to financial market, to the investors, and to their staff also. Okay, and one of the problems is how to do that. I'll come back in a minute on that. Following there was a press conference, June the 7th, and then you see between starting June the 6th, another step has to be managed. The announcement is made, everyone knows what's happened, and finally what's happened on the price of the characteristic of the share price and the others like volumes and volatility. It was decided, and I already explained that partly, by the company to resell part of this company because some of the assets or operations were not in the core business of BSN Group. And in fact, it was decided to resell 2 of the 3 subsidiaries in England. The last 2 subsidiaries I presented, I thought it was here, Savard, Smith and Walkers, because they were involved in snacks, crisps, and seeds, which are not in the core business of BSN Danone. So for financial reasons, of course, but also for strategic reasons, it was decided to resell these 2 firms and this kind of version as soon as possible. And I will explain what's happened. They found very quickly among the large firms in the biscuit industry, PepsiCo interested, and they negotiated PepsiCo, and a few days later, they signed the contract with PepsiCo. So what you find here are the steps of a process, in a process which is characterized by a situation, in fact, in favor, which is in favor, environment, competition is in favor of the seller. And the seller is also in situation of financial stress. He wants cash as soon as possible, first characteristic, which means short due diligence processes. Second, even the negotiation itself was short, about 1 week. And then it was decided by the buyer, BSN Danone, to resell part of the firm's bought. It means here 2 out of 5, at the same time for financial reasons and for strategic reasons, coherence with the core business of the group. That's what you find. Yeah. So at that stage, let's see to how it was organized and what everyone is doing. One of the interests of the case here is to integrate the classical dimensions you find in the textbooks and in most of the cases, but also how is it organized in the financial management team? How do we work with all the departments in their group? How do they work with consultants? How are they organized in terms of task, goals, timing, all these important elements which make the success of an operation. So first, after the meeting in New York City on May the 11th, and before the decision, which is on May the 29th, you see May the 29th here, the due diligence process, memorandum studies were organized around 3 different topics. The first one is an analysis of a strategy. What are the strategy or strategies of the 5 firms involved in terms of products, in terms of market, in terms of competition? So, of course, it was partly known because it is the same industry. This industry is very well known by BSN Danone. It has also been prepared because as soon as the hostile takeover bid of KKR on Nabisco began, it means about 3 months ago, teams in BSN Danone were dedicated to the analysis of the Nabisco firm in Europe. It was clear that KKR didn't have enough cash to manage this operation, and that probably they will sell, as the US-based group do, their subsidiaries abroad. So a small team worked already on that. Second point is on the synergies. So we have already made synergies in the preceding cases. We'll go further with more details and tables in other cases. But we had to calculate the synergies, figures, put the figures, identify synergies, reduction of costs, more business, and increase in income, to put figures on that, perhaps scenarios, but also a schedule. How long is needed to obtain these synergies? So what to do with that? How long to obtain? So this is very central because these synergies are part of the margin. Then third point, financial studies. Financial studies, 2 points, dilution and financing. So that's the 2 main points. It means what's happened with this acquisition, which is large acquisition for BSN Danone. What does it mean in terms of dilution of control? What does it mean in terms of dilution for shareholders, in terms of wealth? So wealth and control. And on the other side, probably the most difficult element, what about the financial structure of the group? What about the right side of the balance sheet? What about debt equity ratio? What about the debt capacity? And what are the consequences on future operations? Okay. So these were the 3 topics for the teams working, on this due diligence processes. So who is working on that? And you see that on the right. Strategy, the M&A department, the department in charge of all these operations, these investment, acquisition, merger, and so on. Second, the business line. So the group was organized. The group was organized around several departments. Department for each of the branch, in fact. So at the end of each branch, there was a small group of persons organizing or dealing with the control of the firms in the branch, and dealing also with the transfer of good practice and wordings. So they were involved. Just a minute. Françoise, c'est Yeti, tu réponds pas et tu dis rien. Hein? Tu dis pas ce que je fais. Excuse me. So, of course, consultants were hired. Then you see, but consultants have a very specific stake, in the development of the studies. Okay. Second, synergies. For synergies, you have the same thing. You have the MEA department, and you have also the business lines. Also. For the third one, financial study, it's a bit different because you have a financial manager plus outsider, the bank in charge of all the operations, I would say important operations, equity issues, for examples, the advisors and consulting on acquisitions, which is Lazard. And you have also the other part of the financial team, in fact, one of them being dedicated to financial resources, to cash management, to communication, financial communication, and the other one being more dedicated to control, accounting, and so on. Okay? So this is what we have. This is what we find here for the strategy, the synergies, and the financial study. Okay? And this was at the end presented, to the committee. This was presented to the committee, made of the board members, of some experts, of the head of the financial, of the M&A department, and a few persons involved also of the process here. So we are on May the 29th, and the quality of this process of due diligence is very important, particularly when it is a short process, which is the case you find here. Okay, May the 29th. May the 30th starts, as you know, with global negotiation in New York City. Global negotiation starts on May the 30th. So I will go into the detail of that. But anyway, what you should know is that, only a few persons were leading the negotiation. In fact, 3 persons on both sides. And as BSN Naden is concerned, CEO Antoine Wigou, the CFO, which is General Financial Manager for the group, Christian Labrie, and the chairman of Lazard Bank. After that, of course, you have a team, and a team of about 35 persons. I will explain later how it works. 6 days after, you have the contracts, and it is based on this global and detailed negotiation organized around 2 teams of more than 30 persons. Okay. And among these teams, you will find different kinds of field of expertise, MBA department. Part of them is outside, and outside you find Lazard, the banker mainly for equity issues, for complex operation convertible bonds, and also for the restructurations, acquisitions, but also another one which is the leading bank for the debts, which is Crédit Lyonnais, which is now Crédit Agricole. You see later on another case that it has been bought in the meantime by another bank. So you have in fact two banks, really the leading one, which is involved in the structuration, into the goals, into the strategy, into the acquisition and the equity issues and complex financial operations like convertible bonds, and on the other hand, Crédit Lyonnais, Crédit Agricole, which is the leading bank for bond issue and negotiation with the banks, because several banks will be involved to refinance the deal. And after that, June the 6th, you get the closing. You have to pay 2 days later, so the payment has to be organized. And also, information has to be given to the market and to the shareholders. The problem of how to inform the market and the investors was with public statement is needed. Is it the same for the press, newspapers, media, stock exchanges, different kinds of investors, or is it segmented? Do we have to give information immediately after the signature or not, and why? All these questions managed of financial information are managed by the communication team, financial communication team, which is depending on the financial department of a general financial manager. But after that, you have a last step. And many studies show that the last step is much more important than any other one. It is what we call the post-closing. You will not find post-closing elements, or schedule or goals even in the financial textbook. But it takes time. It takes weeks, sometimes months for our deal. And it is the process of first checking if what you have signed, what is in your contract, is in line with what you find in the different firms, to deal with the complaints, price adjustment, if price adjustments are necessary, because what you find is not what is in the contract. Also, integration, and integration mean integration into the budgetary process, into the planning process, and of course, the beginning of the financial consolidation of a deal. And this last step involves all the financial affairs stuff. It means not only a financial team involved mainly into debt issues, negotiation with the bank, stock markets, financial communication, but also teams of accountants making consolidation, the control system, the reporting system, the tax department, the legal department also. So it's a large number of financial and data, I would say, team which are involved, plus of course, engineers, experts in marketing. So it's not only finance, it's not only general insiders. You need consultants here again. Of course, your auditors, but also experts in identifying, accelerating the synergies. There are small firms involved in that kind of process, and you need really them. Okay, so there are many persons and teams involved from the beginning to the end of the process. Part of them, let's say globally, about 50% are working for the group, and about 50% are consultants, if you include in consultants, the lawyer, the auditors, the expert in strategy, the expert in synergies, and so on. So this is how it works. So it's a process which has to be done very quickly with many persons. It means it has to be well prepared. And when you analyze this working method organization, this also means, that it has to be really prepared before. All these persons moved to New York City from Europe, and they have to know the others before. So in negotiating properly a deal like this one, and in being successful after that in the post-closing step, you need some kind of apprenticeship. I mean, generally it was the case in that group. You start with not too complex, quite simple, and quite small operations. And progressively you move, and you become bigger at the same time, of course. You move to more international, more complex, larger number of firms at the same time. It means you buy groups and not only one firm, but you cannot succeed in doing that if you don't learn step by step how to manage that kind of process. What I said is, for a group like this one, there's about 50 operations a year. Some of them are small and very simple, but from time to time, you find a very complex one, like the one we are dealing with. Perhaps a few more points on some of the details, about the negotiations themselves in New York City. You agree to negotiate in New York City. It is organized in a hotel, and it's really here. It was 5 days, 5 nights. But which means also that the teams have to be very organized. When you get about 35% on your side and 35% on the other side, negotiation has to be prepared. That means the days before the global negotiations start on May 30th, even before the final decision of the committee, which meet on May 29th, well, as known, a small team, both sides, two small teams, 3 persons met and organized the following days. It means they identified the main topic. They decided to organize in about 10 different meetings the process of negotiation. They prepared checklists in order that all the points are analyzed. And when the 35 persons, are in New York City, both sides, they know exactly what they have to do. They know the identity of the small teams, 3-4 persons on the other side, and both of them have the checklists. The preparing committee has agreed on. And for example, you can have a committee, on taxes, a committee on legal balance, You can have a committee on synergies, you can, and so on and so on. Okay. Each meeting between the two small group of three persons in average with a checklist, they write. It means you had about 10 small committees made of two small subgroups of 3 persons. They have the same checklist and they go through the question one after the other. And each time they agree on one of them, they write. And they have to be very careful. And you have to be globally also very well organized, because all what you write is American law. It's part of the contract. And that's the explanation why you find these, after a few days, you find this very big contract, several thousand pages. It's because it's organized this way. And of course, all what is written by the 10 small negotiation has to be checked. So there's a transversal committee which read all the paragraphs, answers to the checklist, to the questions, validate them, modify them, ask for modification, ask for more details if it is not so clear. But by the end of the week, thousands of pages are written, have been validated, at the end accepted by the transversal committee, and the committee is able to have a list of points which some have a disagreement, or let's say not complete agreement. And among these points was 5 or 6. In that case, there was a price. Let's say to simplify, these then wanted to pay around 2,400, and on the other side wanted 2,600, 2,650. Okay. So what to do with the 5 or 6 questions left? Now they are brought to a committee, the CEO committee, in fact. The CEO committee was 3 persons both sides. For Dan Group, it was the CEO, Mr. Ribou. It was the representative chairman of Lazar Bank, Mr. David Vell. And it was the general financial manager of the group, Mr. Lobby. Same on the other side. And they met, it was at the end of the night on June the 6th. And they met with these thousands of pages and a few questions left with the summary and the position of the both companies. It didn't take very long, in fact. It didn't take very long. It took about 1 hour. And at the end of the hour, they agreed on the different points. And what is quite interesting is that, they don't go into the details. When they had to deal, and this is a good example, on the price, and on one side we were around 2,400 and the other one 2,600. They concluded very quickly that 2,500 was a good compromise. That was not the question. That means also, again, the value calculation, because of course both sides have made value calculation with all the methods, and they obtain a range, and taking into account the circumstances, they have targeted a price. The two prices are not the same, so you have to make a compromise anyway. So they didn't start again, with the models. They just decided to make a compromise. After that, one of the main questions to deal with is the question of the announcement. So, on June the 6th, it's very early in the morning, about 7 a.m. All the members of the teams are exhausted. They've been working for 5 days, 5 nights in a hotel, and it's just signed. Everyone is happy, both sides. They are drinking champagne, and the question is what to do next. And of course, one of the potential scenario is to say, okay, we made a gentleman announcement and we send call and to market and to banks and to newspapers and TV network. This is the easiest one. But the second point, we have rules of the market, and all large markets for listed firms it is forbidden to communicate information during the time the market is on this quotation. And the problem that it is 7 o'clock, in the morning in New York City, but that means when it is 7 a.m. in New York City, it's 12 in London, noon, and 1 p.m. in Paris and in Frankfurt. So that means if you give information at that time, it will come in the middle of the session in Europe. And rules say you have to give that kind of information before the opening or the closing of the market. So what to do? And the first element is to say, okay, we will give this information after the closing of all the markets the stocks of the companies are listed on. It means after the end of the trading operation in Europe, but also in the US, in New York City. It is 7 a.m. in the morning. That means at least 5 p.m., 10 hours later. Why not? But first, when you analyze this, it is clear that you cannot keep information secret for 10 hours. More than 70% have been working on that. They want to leave, they want to go back home, want to give calls. You will have rumors on the markets. And at the end of the process like this one, we try to give the same information to everyone and not to interact with the prices of the market and the volumes also of the markets. So a kind of mixed or intermediate solution was chosen. It was decided just to give the information. KKR, Nabisco, and BSN Danone met in New York City for the last few days. They agreed this morning for the acquisition of 5 companies belonging to Nabisco for an amount of $2,500 million. A conference will be given to investors tonight after the closing of the US stock market. No more than that. And 6 p.m. New York City, there was a press conference giving all the details on the deal. So that's the kind of solution you have to make, taking into account the fact that it is very difficult to keep the information secret, and at the same time you have constraints which give a kind of constraint which has been passed by the regulators to optimize the quotations on the stock markets. Next point will be on what happened on the market in that case. what's happened in general after that kind of operation. So let's go very far. We are here with slide number 10, and I will show you two slides which are somewhere here. How to find them again? I thought it was around 20. Where are they? I'm looking for my slides. Yes, here we are. So I have two slides, slide 30 and 31. Let's have a look to slide 30 if you want to understand what's happened very often. This is the price on the Paris Stock Exchange. You should know that for firms which are quite international, very often they are listed on several stock markets, but there is still what we can call a dominant stock market. It means the stock market where the higher volume are traded. And in that case, with a group which is based in France, even if the group is quite international, with headquarters in Paris, with a French CEO, the French Stock Exchange was the dominant stock market. So what you find is the price of a share of BSN Danone on the Paris stock market during this process of quotation. At the time, the information was, the simple information first was given to the market. Remember that the information was the signature occurred at about 7. The information was given to the market with a short communique about 30 minutes later, between 7 and 8 a.m. New York time, and 7 is 1 p.m. It's between 1 and 2 p.m. Paris time. The price of a share, BSN Danone, last price the day before, June the 5th, was 709. In the morning, let's say 9 a.m., opening the market in Paris 7:10. And then suddenly, a few hours later, there was a communique. And immediately the price went up from 7:10 to 7:41. From 7:10 to 7:31. Okay. And it was kind of immediate reaction, kind of Pavlovian reaction. Okay. In fact, the markets and business and they have made a new acquisition. It seems to be a big acquisition, but they have a good knowledge of what to do and not to do in acquisition processes where they've nearly always been successful, have a large experience. So this is good news. And it went up immediately in a few minutes. But after that, financial analysts, brokers made calculations, and they understood that it was really a big, in terms of size, in terms of financial consequences of commercial acquisition. Okay, and they thought when they analyzed in detail this acquisition that it was quite risky. It was not so sure we will be able to refinance easily the deal. And the size, which is large with 5 firms in 3 different countries, bring also a proportional risk. It means it was not so clear they were able, to deal with all the questions raised in the integration process. So there was clear question on the financial side, but also on the operational side. And the price of share of the market started going down regularly, with two other elements coming in. The first one is an increase in the volume. This is what you see here above the graph. The volume of that day and the days after was about 8 times the regular amount, about 8 times. And of course, it's high volume, but it is high volatility. High volatility, high volumes and high volatility. And when you get high volatility, of course, prices are, the trend of the price is going down. But in the same day with high price, low price, and so on, it's moving. It's moving. Okay. And when you have that kind of increased volatility, what you find also, it's a new category of investors coming in, what we can call day traders. It means they just come to manage volatility investment and to trying to make money. And when you have a high percentage of day traders on the market, on the exchange, generally it increases again the volatility. It means volatility is a factor of increase of volatility. This is what was shown. So let's have a look to what's happened the day after. The day after, here we are. Here we are, and you start again with 709, by the end of the day, 691. And the days after, up to the end of the month, and it's 3 weeks after, we still have a decrease. It was lower, but we still have a decrease in the price, very high volume, very high volatility at the same time. So, when we have high volumes and high volatility, that means that you have, of course, a high percentage of shares which are traded. And when you have a large percentage of shares traded, that also means that at the end of this period of time, you don't know exactly who are your shareholders and what kind of investor you will meet at the next annual meeting. So there is a risk, at least in particular for firms with a minority stake in the hands of managing group, to lose the control. There is a control risk here due to this process. So this is the reason why, there was a series of counter-attack in order to improve the situation or to re-equilibrate the situation. First one between the 7th and the 30th were made of communication, financial communication, conference press, meeting with analysts, meetings with investors also. They were partially also supported by a few banks, Lazard, Crédit Agricole, Crédit Lyonnais, who bought in their funds a part of the shares sold on the market, but that was not enough. And in the strategy, it was already decided to try to resell the two British companies, which are company number 4 and number 5, which means Smith and Walkers, and to try to find a buyer, to have a quick negotiation, and to be able to announce to the market that the size of a deal is reduced, which means also, a size which is more acceptable and less risky, So they were looking for a potential buyer, and they started dealing with that problem even before the signature on June the 6th. They knew that if they decided to buy at the end and to sign on June the 6th, they have to go into this process of resale as soon as possible. So they already made a study in the M&A teams in order to find a potential buyer. And what you do in that case is a short list. To make a short list, what is the number one potential shareholder? What is the number two? What is the number three? This is what you do. Number one, number two, number three. And when this is done, you ask your CEO to call the CEO of the number one. And this is what was done. And they agreed to meet, or that their teams will meet. Okay. And in fact, they started the first meeting by June 26 or 27. It seems on June the 30th that they nearly agreed. And finally, they signed an agreement on July the 3rd. It was PepsiCo, the number one. The situation was so difficult for BSN in terms of control, but after a few days of negotiation, it means on June the 30th, when it was nearly clear that the negotiation would succeed, and that the next step will be after June 30th to manage, negotiate details. It was decided just to communicate very simply and to say to the market, after the end of the day of the stock exchange, PepsiCo and BSN Danone are negotiating at the moment for the resale of Smith & Walkers, and the negotiations are well advanced. And immediately, I would say, the stock market price moved up, and the volatility was immediately reduced. We still have high volumes, volatility was reduced. Okay? And on the 3rd of July, the final contract was signed. The price was already up to 697, that is what you see here. And by the end of the month, it was 755, which means it was higher at the end of the month of July than it was on June the 5th, before the announcement of the deal. That means by the end of the month, the market took or weighted the potential, the positive side of the deal better than the negative aspects, for example, the problem of dilution. So when you say that, okay, you say if there's no problem, it's successful. Yeah, yes, it will be successful, but not immediately. And there was here, between June the 6th and the beginning of July, a period of risk with the modification of the shareholder group structure. That means whenever even you are at the end of July with a price of a share of 7.5, you don't know, as a CFO or CEO, who will be the shareholders in the room 2 months later at the time of the annual meeting. So the risk of control is still there, okay? Even if you have limited the extension or development of the risk of control with the operation with PepsiCo. So that means you still have a risk of dilution of control, and you have a risk of dilution of wealth, which is still there. So, that kind of large acquisitions when they have particularly to be paid in shares in short period of time, they are risky. They are perhaps very positive in terms of strategy, but in financial terms, they are risky and they have to be managed very, very carefully to hedge or to reduce this risk of control, this risk of wealth also for the shareholder group. This is what I wanted to show you here are the consequences of it. So I go back to my slides, where I was a few minutes ago. This thing, okay. Here you are. And now I want to show you that slide, which is very central. If you raise the question, at the end, what is the most important data calculation at the time you decide, at least for financial dimension, not the strategic one, to go into the deal? It means on May 30th here. What is the most important? Is it financial structure? Is it the volatility you can forecast in the share price, or is it something else? And the main part in it. And I've seen that several times in the different operations I've been through with Banque Lazare or with BSN Danone, or later in two privatization process. The main point is this one, which is the dilution of net earnings, what is called generally wealth dilution for the shareholders. So you have a very simple and clear table with calculations here. What you find in the first line, remember you are in May 1989. And on the first line, what you find is the expected, the forecast, if you prefer, of net earning per share for 89 and 1990, 47.5 and 52. We say, how is it done? It's really done with what we call the consensus of the analyst. I mean, we have a large company which is well known. This one, you have about 15 on the list, which are making the calculation in different banks or book companies. And you get your data and you make the average. And at a 6-month horizon, 1999, you get 7.5. And 18-month horizon, end of 1990, you get 52. And the last available, published, audited data was 41.7, 6 months before, 41.7. So it means you calculate the growth rate and you have a low 2 years before also. And your conclusion is that, in average, the growth rate, the trend of the net earning per share is about 12 to 13% a year. And when you have a trend of 12 to 13% a year, it is also clear that your shareholder group, your shareholders, were accustomed to that growth. That means that's a kind of shareholder who doesn't like risk very much, but they don't ask you for 40%. They ask you for a kind of regular growth rate. They want to know what will happen in the years to come, and they are not interested in having their cash, their money in a share, which is going down by 10% first year, going up by 20 or second, by 10 the year third and declining by 5 year. No, we don't want that. They want some kind of recurrent growth. And of course, you have a specific risk aversion profile. And you have to be very careful when by your decision as a CFO or CEO, you modify this profile of a trend. There is, you need to have a shareholder group which is in line with your policy, your financial policy. This is very important in acquisition processes, in image, in value also, because there's empirical research show that there is a premium which is given, allocated, given allocated for the stability of trend, stability of the growth of the earning per share. But now you have this financial operation. You have this financial operation with acquisition of 5 firms, the 5 subsidiaries of the Nabisco Group in Europe in the biscuit industry. So immediately, what are you doing, and what all the analysts are doing? They are recalculating the consequences in terms of structure of a balance sheet, but also consequences in terms of the dilution of wealth. And on the second line, you get, the consequences. It means the net earning per share expected 6 months after is not anymore 47.5, but is 41.2. And in 1990, 18 months later, it will be 43. So now you have to be very clear into the analysis. That means if you compare 41.2 to the last net earning data available, 41.7, you have a decline, and it's what we call negative growth, which is -1%. But now, the information which is in the market is quite efficient, at least semi-strong. You compare 41.2 and 47.5 coming from preceding calculation, and you find a decrease, but the decrease is much larger than the decrease in the growth. It is 14%. That means you had the market, he knew the last month's data, 41.7, and it takes into account all the information available. And among this information was the most important one, was the forecast for the net earning per share at the end of the year and the end of the year after, 47.5, 52. You go through an acquisition, and the new calculation shows that the expected net earning at the end of the year will not be 47.5, but 41.2, and the market integrates this information. It will raise negative consequence, of course, of the price, and because it's non-expected information, it has an impact on the volume and the volatility, as we know. So -14. Do some calculation for the year after, and you compare 43 and 52. And you have a growth now, a dilution now, which is 17%, a decline of 17%. And if you compare also the growth rates, it's only +4, but it is +4, it's positive. Now, if you resell Smith & Walkers, the 2 British companies, and keep only 3 companies, okay? What do you find? You find 43 for the first year, and you find 47 for the second year, okay? So now if you compare 43 to 41.7, it's a growth of 3%, and the year after it's 9%. But as far as the dilution is concerned, if you compare 43 and 47.5, you have minus 10%. And in 1990, if you compare 47 and 52, you have minus 6%. Okay. So what's happened? With last solution, when you resell a company with this and then resell Smith Walkers very quickly, with an improvement of a net earning per share. The growth is not 12 or 13%, but instead of being -1 and +4, it is +3 and +9. And of course, the presentation was such at the time that it was said, oh, yes, we only have a growth of 9% in 1990 instead of an expectation of 12 to 13%. But 1 year after it is 91, the growth will be back on the long-term trend of 12 to 13%. And dilution in absolute value is also decreasing, -10, -6. On the second line, it is -14, -17, it's much higher. And it is increasing from one period to the other. So that means clearly that the first solution to buy the subsidiaries and to keep the solution to integrate these companies was very difficult to sell to the market and to the investors. The second one with the reduced format, 3 companies instead of 5, was much better, was acceptable. So this calculation, convinced, of course, the management of BSN Danone to accelerate the resale process of the 2 British companies, Smith and Walkers. And this is very central, in the decision process. And you will see in our cases, this is very central. What are the consequences on the net earnings, on the dilution of the wealth of our shareholders, on the operation and its financial consequences? Okay. What could we do if a situation is analyzed as risky to improve the situation as soon as possible? And very often is to resell assets. Sometimes it's part of the assets which were just bought, and sometimes it's to resell some of the assets which are in the portfolio of operations of assets of a firm, but not the one which were just bought. Assets which were owned for years, but are becoming marginal into the core business of a group. So this is really what I wanted to show you. And, at that point, after having a description last time of the operation itself, of the firms, I went first, into the analysis of the financial consequences, and the next step will be to deal with that. We understand that the problem is not a problem of integration of the operation. It is a process, it is a problem here to solve in terms of balance sheet structure, refinancing, accounting. This is what we have to solve. This is the first thing we have identified. Second, we know that capacity to make zero mistake and to go fast in the process is very central. And they succeeded in doing that. We know also that large acquisitions involve a large number of participants, insiders and outsiders, and with different field, specialized in different field of expertise. Then we know also that we have to have elements which are quite important. The one is the wealth dilution, which I explained, I think, I hope, quite clearly on this table. And second, it is at the same time, you have to manage that at the same time, it is the impact on the stock market, on the price of a share, and not only on the price, but also the characteristics in terms of volume, in terms of volatility. It means also in terms of management of a group of shareholders. So you are not here dealing with wealth. It was done in the preceding slide, but you are dealing with the control. What about dilution of control? It is at least as risky as the dilution of wealth. And it is underestimated as a risk very often in the operation process. And you understood probably when you have looked to this slide and make some comments here that even when the price of a share is back at the level of the price before the announcement, or is even higher, which is the case here, you still don't know if you have a problem with the control. It means of the percentage of rights to vote of the annual meeting, which are under your control. And you will see that generally only we have good knowledge, precise knowledge of that only at the next annual meeting. So these are the questions, we have made here. So what are the next points now? The next points, and this will be very quick, is about legal dimensions. Very important, but this is not the central part of the presentation here. So I have a few slides of that. We do that, and then we will move to something which is quite important for financial managers and bankers, which is what to do with this balance sheet structure, how to improve it. Can we do it quickly? Do we need time to do that? And what you will understand very quickly is that the traditional presentation of a textbook is not true in large and complex acquisition. It means you don't find the solution immediately. You find part of the solution first. And then it takes time to go further and to optimize this financial structure. And then after that, we'll have a look quicker to some of the consequences in terms of currency risk, in terms of accounting, in terms of tax optimization, and so on. I will go much quicker on that. Okay, so we will start with the legal part, and the legal part is just after the dilution analysis here. It is somewhere here. Yeah, it is. So it's before, we start before. We start here. Okay. So that's where we start. Okay. So it's we have been developing this presentation for a long time right now. Let's have a break, please, of 7 minutes, and we start again with the legal dimensions. Okay, I think it's time to start again, on that case and to go further. So you have a few slides, you will read that by yourself in details, But let's say, put it that way, in that kind of agreement, we deal with several main points. The first one is how the accounts are presented. Of course, do we have accounts which are audited? And what are the problems with the accounts between the beginning of the year and the signature? Here, signature occurred on June the 6th, It means what's happened between January the 1st and June the 6th. Do we have only pro forma accounts with a risk which are involved? What does it mean in terms of risk? What does it mean in terms of guarantee? So this is the problem. Second, what are the rules, the principles, the standards, the norms, which had been taken into account and incorporated, into the contract? And we find generally very clear and traditional sentences on that problem, with the fact that here it was written that all the accounts were presented according to the US GAAP, and if there is some modification or some specificities because of the industry, because of the timing, it has also after that to be written. This is the second paragraph here. Next point, it's about the level of the guarantees. What about the level of the guarantees? You have the debt guarantee, which is here very high. Remember that the deal is for 2.5 billion euros. And of course, if there is something which is identified after the audit, which will occur, later after the signature, and the contract itself, there is a guarantee on the price which has to be brought. All the differences between what you find in the audit and what you find in the contract have to be paid for. A reduction in price has to be brought. So here what you find is that these potential payments should be limited by a few rules. First, the maximum here is 1.25 billion to be compared to 2.5 billion, okay, for the transaction level. That means, it's very high, that guarantee. It's 50% of the total, 50% of the level of the sales. Which means also that the seller is very confident in what they sell. There is an exemption. There is always an exemption here, which is 5 million. That means it's considered, as normal. We will not come back on negotiations on price reduction for a small amount, so a percentage of the total level of the sale. And even if we have small problems, each one below 5 million, and if the total is less than 10 million, it will not be taken into account in a further negotiation. So you have the 30%. You can have a fiscal system guarantee. Here is no time limit, and there's just a first exemption, 4.5, which is very limited. There is one for restructuration. So what you should understand is that you have guarantees for debt, guarantees for fiscal, for taxes, guarantees for restructuration, for other topics, different guarantees, and generally limits are fixed. Here there is something which is specific and quite interesting, it is the guarantees on the brands, Nabisco had brands, they use these brands in different environments, and different countries, different parts of the world, and of course, BSN Danone in Europe needed the logo Nabisco and the Nabisco brands, at least for an intermediate period, it means a few months, 1 year, 2 years, before using its own brand of the products which were bought. So you have, agreement on that and guarantees for Nabisco for kind of positive, good use of the brands in Europe. And you have also generally a guarantee, which is a pension fund guarantee. In many countries, and particularly in England, part of the pension, future pension of the workers and staff, is managed in the pension fund. It means they pay, each worker pay, and the firm pay also each month for their future pension when they retire. And these amounts of money are managed in a fund, and very often are managed in England by the company itself. So that means the company either really manage the fund or choose a bank, an insurance company, who will manage the fund. So the problem is the problem of responsibility. And if, for example, the amounts which are available in the pension fund have decreased because management wasn't good, it was too risky, and so on, the buyer don't want to support this risk. So pension funds, particularly in industries with large amount of workers, have to be clearly analyzed at the time of an acquisition. So there is a guarantee on the level of cash available in the pension fund at the time of the acquisition. So what you should remember is that we have several guarantees. First one on the accounts themselves, and particularly on the accounts between the January the 1st and the date, the time of the signature of the contract. Next, on the accounts and the standards and formats used in the accounts. Also, on the guarantees for debt, guarantees for taxes, guarantees for restitution, and guarantee for grants and pension fund. That's what we have to remember. Now, I want to show you something which is more in line with financial problems, and which is here with the slide here on the first step, the slide here still on the first step, second step, and third step. So we have few slides here which has to be explained and show how it was financed. It's a 2.5 billion deal. And this has to be paid in cash in a very short period of time, 2 days after the acquisition. And of course, it was prepared the day before. The first element is here. First element is price down payment. And the price down payment has to be available immediately. And if you compare the size of the group, its capacity to issue bonds or equity, new shares on the market, the level of cash to transfer to New York City, it cannot be done clearly on the market. It has to be provided by banks. And here it was provided by the main bank, in terms of debt management, which is Crédit Lyonnais, now bought by Crédit Agricole. And they brought a credit line, which took into account partly multiple facilities which are already available for $2,500 million. And of course, negotiation was very difficult for BSN London, and they had to accept the conditions of the bank at the time with a high interest rate. But the bank provided the necessary cash amount to the company. The second point here is, of course, that if you analyze the situation after the payment, June the 6th, you have the signature. June the 9th, you have the payment. Consider the situation on June the 9th. The BSN company has the right side of the balance sheet with a very high amount of debt, very high debt equity ratio, and for the debt as it is, short-term maturity. That means they will have to pay back this debt in a very short period of time, several months, and they are clearly unable to do that. Okay. So the problem is what to do with this characteristic of the balance sheets, level of debt which is too high, short-term maturity with a liquidity risk, high level of interest, financial costs which are too high also, it will reduce the net earning per share again. So it is here, it has to be restructured, consolidated, modified. And even on the side of the bank, a short-term line like that for $2.5 billion, it's a very high concentration on one customer, short-term, even if his customer is well rated, it's a good, well-known company. So that means inside the bank, the risk manager and manager ask for a reduction of this amount. So both sides agreed on the fact that something has to be done. And on that slide now, you see what's happened in terms of consolidation. What's happened in terms of consolidation? 3 different things. The most classical one here is the bank loans. Bank loans, that means, in fact, it's a swap of the short-term loans, less than 1 year, against 5 to 7 years maturity loans. That's what you find here. And 5 to 7 years maturity loans were organized in a pool. That means Crédit Lyonnais, as the head of the process, had two different missions. The first one was to find several banks willing to participate to this bank loan structure, new bank loan structure. And they had also, after that, to coordinate the management of the pool and to bring by themselves part of the liquidity, part of the cash. So they organized this in such a way that out on a total of 16,875 million of French francs, we find here a very high percentage, 9.8, 9,800 million, taken into account, refinanced, if you prefer, by this pool of bank. That means on the side of the bank, they keep a customer. It's a very good customer every year. They have several versions of them. They accept to reduce or to eliminate the short-term loans and to transfer, to swap them against medium-term maturity loans. But in terms of liquidity risk also, they keep only part of it. You see, it's about 20-25% only. So that means this is in line with the demand of the risk managers, controller of a bank. On the other side, on the side of the company, means on the side of BSN Danone, it's also good news because now they have consolidated a large part of their debt, about 60%. And the liquidity risk has decreased, of course, liquidity risk has decreased. And the cost also has decreased because the company, BSN Danone, was at more time and was able to put some competition in the process and to obtain a reduction of the interest rate. It means a reduction of the cost. So if you have a look to the accounts of BSN Danone, this means a better debt equity ratio. That means reduction in liquidity risk. And this means also in a reduction into the financial cost interest rate, an improvement into the expected future net earning per share. But they added, two other elements and to integrate, let's say, two other goals. The first one is at the bottom of the page. It is commercial paper. And the second one is the upper line. It is multiple option facility, commercial paper and multiple option facility. Commercial paper. Why commercial paper? And what is commercial paper? Perhaps you are not very familiar with commercial paper, which is a very well used technique in the world. Commercial paper is a loan from a non-financial firm to a non-financial firm. It means in a commercial paper operation, there is no integration of the bank or another financial player. And of course, if you don't integrate the bank in the middle, generally the conditions are better. Both companies, they share what the bank is obtaining in terms of earnings from the operations. So first, it can be less costly. Second, it's done on a quick basis. That means it's for large, medium-sized firms and large firms. It's done directly by the treasury managers, and it's organized with the modern system of transmission, computers mainly, and the amount of cash is transferred before anything is signed. It's the agreement is an old agreement, and the market is built, is organized on this confidence into the acceptance of both parties. So it's a market which can be, which is a very flexible and free market, and loans can be for 3 days, 10 days, 20 days, 2 months, 6 months, 2 years, and so on. But anyway, what we see on the market is that the market is concentrated today in large number of the countries where we use commercial paper. There is a concentration on 30 days operation. It means you have 2 companies, A and B. A is lending line of credit to B, 30 days maturity. There is no payment between 30 days. There is one payment one side on the first day. The loan is paid back 30 days after, plus the interest. It's organized like a zero amount, in fact. First, it's a very non-costly operation. And second, it is flexible because you can, as a company, as a treasurer, you can go in this market every day. And anyway, the consequences of the decision one day is only for the next 30 days. So flexibility and cost. And we use that partially, at least, we use that for 1,675 million French francs. And the last one, I have nothing more to say because I already explained that, The last one is use on multiple option facilities, okay? $800 million, okay? We use through new multiple option facilities, which is quite large. It's 5,400 million French francs, which is about 1/3 of the total refinancing structure. So with these 2 lines, multiple option facilities and commercial paper, they have flexibility, which is not brought by the bank loans. So one of the strengths of bank loans is that you know exactly how much you borrow, interest rate, when you have to pay interest and pay back, And generally, general managers, particularly, are not very good in finance, like this. But after that, if you want to bring more flexibility into your financial structure and financial policy, you need something else. And multiple option facility and commercial paper help you to answer to this goal, So very often consolidation are made with these 3 kind of needs financial resources. Bank loans, this is the basic classical structure. And then multiple option facilities on 3-4 years horizon, and commercial paper, very short horizon, about 30 days. And you bring at the same time good knowledge of what you have to pay back with bank loans and flexibility with the 2 others. So at the end of this process here, the group is in a situation, BSN Talent Group, the main risk have been hedged. That means there is no more liquidity risk. Okay. The finance source structure is with debt, with longer maturity, and with more flexibility and less costly. But the weakness, probably the main weakness, it's still there. A very high debt equity ratio. Very high debt equity ratio. This is what you find here. So that means there is still one point to solve. It is to reduce the debt equity ratio. And if you want to reduce the debt equity ratio, either you are able to pay back, but to pay back, either you at the point in time you have very high cash flows, or you sell assets, or you have to increase by use financial policy to design your equity level. So that's where we are. For the banks, the problem is solved. For Credit Lyonnais, the problem is solved, clearly solved. One more point, perhaps, to understand very well what's here. Why do you need flexibility? It's very simple. It's just because the bank loans are paid with the cash flows. And you don't know, you know exactly what you will have to pay as a company to the banks in the debt contract, but you don't know what will be your future cash flows. This is very clear. So this flexibility is an answer to adapt to the production of the future cash flows. Now, you have a third slide here. You have a third slide, and this is the first step. And you understand that this is taking months. And if you have a look to all the schedule between the first element, cash payment, and the end of the process of long-term refinancing, there is 18 months. So that means we are very far from what is written in the textbook, which is in the morning we choose the investment, or we agree on the acquisition with the seller, and the afternoon we find the best solution. And at the end we go for dinner, and everything is solved. This is not the case. This is not true. Okay. Long-term refinancing. So we have this problem of debt, and we have to try to modify the structure. And one of the interesting points here is that you have, I would say, nearly all the potential solutions which are brought on that slide. Okay. The first one, which is a very simple one, a very standard one, is to sell some assets. BSN Dannen has bought 5 different companies, and they had decided to resell 2 of them. Okay. They have decided to resell 2 of them, Smith and Walkers, and they went into a negotiation with PepsiCo, and we agreed with PepsiCo for $1,350,000,000, which is 9.1 9 billion, 9,100,000,000 French francs. Okay, so part of the problem is solved with this sale, which is in line with the core business analysis. It means it's not something which has been decided just because the group needed cash. It has been decided at the same time because the group is looking for cash for refinancing policy, long-term refinancing policy of the deal, but also because they have to adapt to the core business. What are the priorities? What are the segments of products and countries which are in the core of the group? So you can say, one of the questions generally raised by students or by executive when I make this presentation is to say, okay, but why did you buy 5 companies? Why didn't you buy only 3 of them? The answer is very clear. In front of the BSA Dana, there was Mr. Kravis and KKR and Nabisco, and they wanted to sell the 5 companies as soon as possible against cash. They were not interested by different negotiation with one firm be willing to buy 3 companies and other one or several other companies interested in the last 2. They wanted to have, a deal, one deal only for the total, and wanted to be paid in cash as soon as possible. So the only way to be sure that to acquire the 3 companies which made the core business was to buy the 5 as soon as possible, to pay cash, and after that to manage the problem of these 2 British firms, which was not in line with the core business and which were also raising problem of financial structure. So July 89, this is done. Second, they decided, but it was not new, to seize opportunities. And you see in the first part of this slide, there is what we call the euro-franc issues. So we can have what we call euro-franc, euro-dollar, euro today. What does it mean? It is a franc. Today, most popular is euro, and euro-dollar. That's a euro-dollar is a dollar which is in the hands, which is owned by a firm, by a person, individual, not American, and which is somewhere in a bank and an account, which is not in the US. If you come back to euro-franc is a French franc, which is in the hand of a national, which is not a French national, and this franc is not in a French bank in France, but could be in Switzerland, in London, or somewhere else in the world. Okay. So, and what you find is because in a period of time, some period of time, because of constraints on the transfer of financial resources from one country to the other, or even in a free world, free capital markets, you have different in tax policies. That means the markets are segmented, and that means you find at a point in time, because the demand is local, you find different conditions, particularly different conditions in interest rates on the different markets. Oh, there is an arbitrage. So the difference is not very, very high, but there is a difference. There is a difference. If there is a difference, of course, CFOs of companies and treasurers try to adapt and to borrow the currency they need at the best possible conditions. And here in June, there was an opportunity because the French franc market in Brussels was because of the equilibrium between the sellers and the buyers was different from the one found in Paris or in London. They find very good conditions. It means a lower interest rate. So the company, BS Intended, borrowed the 8-year Infinet bond, Infinet, it was a 8-year Infinet bond, 9% fixed interest rate, for 1,000 million French francs. So this was opportunity size. And when you are dealing with that kind of operation, large operation, you have to restructure, you have to consolidate, you need also to have to size opportunities. The other element which is used here, and if you remember my slides of the presentation of the groups, we did it twice in 1993 in very good conditions of interest rate, and for very large amounts here, you have a convertible bond from 3,300 million French francs, 6.60%, which will be paid back in 2000 if it's not converted. It means it's a 10-year, 6.6% convertible bond issue for a total amount of 3,300 million French francs, with what we call domestic part, which means issued in the original country, in France, and an internal issue issued in London. They are quite complex operations. And, they are very useful. In that case, it allowed, if you used your convertible bonds instead of straight bonds, compare the rates you find on 10-year straight bonds here and on convertible bonds, you have a reduction from something of 9.2% to 6.6%. It's 1/3 less. Improvement in the interest, reduction of costs. That's what you find. Okay. And after that, of course, there are bonds. You have a very high debt equity ratio, and you increase your debt equity ratio again. But what you expect it is that in a few years from now, it will be converted into shares. But you don't have today, with convertible bonds, you don't have any kind of real dilution of net earnings or dilution of control. Dilution of wealth is very, very small, the amount of interest paid, and for the reduction of control, dilution of control is zero. So let's say, to simplify, no dilution of control, no dilution of wealth in the short term. It will come a few years after, and in that case, 5 years, about 5 years. And in the meantime, you can develop a new policy to modify your financial structure and increase at the same time, improve at the same time your debt equity ratio, but also manage your wealth and control dilution. So you save time, in fact, mainly. Okay. And last here, another financial resource was used, and the financial resource which is used here is to sell another asset. But this one was sold only at the end of the process, and it is not part of the Nabisco, European Nabisco subsidiaries. It is another asset which was in the portfolio of products of the group for 6 years. We had two brand, very well-known brand of champagne. I said a few one last time about Pommery and Lançon. And they found they had an opportunity, they sized an opportunity also. And they sold these two champagne brands and production sites to a group you know very well, which is LVMH, Louis Vuitton, Moet Hennessy. It's better known in Asia for the bags, and for probably the champagne and the cognac, but also it's not for cosmetics. And LVMH became #1 in champagne production at the time. So what you see on that side is that long-term refinancing use all the techniques available. We made consolidation before. We extended the maturity. We brought flexibility. But now we have a long-term refinancing policy, which goals are mainly first to improve the debt equity ratio, but at the same time to manage, the dilution of wealth and the dilution of control. At the end of the process, we expect the debt equity ratio bringing again new debt capacity, bringing again new debt capacity, and possibilities, of course, to go further into a process of acquisition, joint ventures, and so on. So this is one of the most interesting points of this case, and probably in different cases. It is the fact that financial policies after large acquisitions are not designed in one day. They take time. And here, if you consider all the operations included, it's about 18 months. Now, we have about 15 minutes to go further into several questions. I will not go into detail, at least right now. First one is this one. You are BNC Danone. The negotiation has been between the staff of the holding company, the group. The group has about 300 subsidiaries. And the head of the group, with the share listed on the market, is a holding company, very small balance sheet. What do you do of all, these debts and assets? You can have two decisions. The first one is to say, okay, it has been bought by the holding, I put the debt into assets and the holding. And you understand very quickly that you don't have the cash flows to pay back the debt and the interests. And the second one is what is done here with the presentation of a small table you find at the end of slide number 20. This is to split the debt and the asset into pieces in order to put them on the balance sheet of companies which are able, with their own cash flow, to pay back the debt. And this is what was done. So that means it's a biscuits investment, but part of the debt and the assets were incorporated into the beer industry, into the dairy product, into cookies, groceries, spring water, packaging. In financial terms, it is the best policy. The problem behind is that if you are the CFO of a group, you call one morning the CFO of Kronenbourg, the largest beer producer in the group, and say, okay, we have made one of the best deals we have ever done. It is in biscuit industry, and we will put in your balance sheet a large amount of debt with your assets on the other side. And of course, the CEO of Esquanambourg subsidiary says, we are in Strasbourg, we are dealing with beer investment, beer management, we don't care about your problem. We don't care about the group policy in biscuits. And this will reduce probably, at least in the first years, our net earnings, our performance, and part of the premium at the end of the year to the workers are calculated on our net earnings. So I will be in trouble inside social problems with the unions. So you have two different policies, and the one chosen by the group was this one. It was to spread, all the element of debt and assets on the balance sheet, which was strong enough to pay back the amounts of the loans and to pay for the interest. And of course, they had to compensate by internal processes, the consequences on the net earnings. This is my first point. The second one, it is a problem of valuation. When you buy 5 firms at a time and you pay for $2,500 million, you don't buy the first one, Berlin, for 700, the second one, and so on. Your negotiation with the seller is for 5 companies as a whole for 2,500 million. But when you come back to your basis, the accountants say, we have got a problem. You didn't say how much you pay for each company. And of course, the total has to fit with the $2,500 million, which is the amount you paid in cash. So you need to have a process of allocation of the total value, the 2,500 million, into the 5 firms, and to register each company with a value which total is equal to 2,500 million. Okay, so I don't want to go further on that point here, but it's a very classical problem for groups. For the currency risk, in fact, we did not have here. Here we don't have, we don't have, here any problem of currency. We don't have any problem of currency. It's a very simple transaction, which is explained here, euro dollar. Okay, and we meet another problem also, which is a problem of goodwill. What about the goodwill? What about the goodwill? We find something which is quite interesting here, which is what to do with this goodwill. Do we integrate it in the accounts, and how? That you have to integrate it into the accounts one way or another, because you have your amount paid. The amount paid is debt. What is on the other side? You have 2 possibilities. Either you reduce immediately the amount of total equity, which is the strategy used by the accounting strategy used by Nestlé, for example, or you decide that you cannot do that because you have a problem with debt equity ratio, and you put something in the asset. That means you have to find a value for the different elements of the goodwills, and for these different elements of the goodwill, you need to apply a technique of valuation. And the main one is the brand. How to calculate a value for the brands. Generally, it's not made inside, even for large group like this one. You ask to a consultant, and we have a few very well-known consultants over the world, very specialized in each economic sector. And for the food industry, it is Interbrand in London. So you ask them to go through this problem and to provide you with value for your brands. They send you reports, you pay them for that, and you incorporate their values into your balance sheet. The financial community validate the results, values, which are presented into the report as they agree with the conclusions of an audit firm or of a rating company. So in that case here, you find the value of a brand, and the value of a brand, if you know that, it's 2,170. And you still have a total goodwill, which is there. And the total goodwill, it means the other elements, which are market share, payments for right to enter the British market and so on, 4,732. After that will be, according to the US GAAP rule, will be depreciated over the years for 118 million. So you put the brand on the one side, all the other elements on the other side, you keep the brands as they are. And today, for example, if you have a look to the value of this portfolio of brand, the market value of this portfolio of brand is much higher than it was incorporated. It means today it is undervalued in the balance sheet. On the contrary, all the other elements are depreciated according to the rules of the accounting system you are dealing with. So today, it is a bit different what you find here, but the principle is the same. So this is not very useful here. I just want to show you something else very briefly, which is this point. Yeah. Large groups are very complex, in fact. And what you find here is the firm itself on the left, upper left. It's called BSN. Okay. You have just below a bank, which is BSN Finance Bank. You have a specific firm using the defense and regulation in Europe, which is BSN Services, which is in charge of a few financial operations and located in Belgium according to the Belgian law. For example, treasury management. You get intermediate companies, and you get also operational companies. Operational companies, French companies, are operations, it means they're producing, selling. Okay. Foreign companies below here are producing and selling, classical companies. But you find also intermediate holdings, like Compagnie Gervais Danone, bought years ago, and having subsidiaries of production and sales. Same for General Biscuit, it was a holding company. So you find operational holding companies, specific financial center in Belgium, BSM Services, a bank, VSN Finance, and after that, other intermediate or specific holding companies, Finalim4, Finalim3, Selva in Italy, BSN UK, of course, the holding of the companies in the UK. So, if you try to summarize, okay, you have a holding company which is the head. You have specific, financial structure. And I gave you two examples: a bank and a financial holding in Belgium, BSN Services. You have intermediate holding very often for branches like biscuit, like dairy products, and so on, which are coming from past acquisitions. You find operational firms producing and selling. And you find also holding companies generally at the, which are the head of the investment in different countries. For example, in the UK, you have BSN UK, which is a holding company. And after that, you will find below this company, you will find operational firm. Jacobs is one of them, producing and selling. So it's a very complex organization. And you make acquisition, it's progressively more and more complex. And this is one problem. You get about 300, that's what I said. More than that is 332 today, I think, subsidiaries. And about that, you get more than 70 holding companies with different specificities, being a bank, be it with a goal of organizing treasury management, making treasury operations, organizing, the financial policy in a country. So part of the activities of this group is also to manage all these holding companies which allow to make acquisition, integrate the firms acquired, and then provide them with necessary financial services to operate. So this was really what I wanted to show you here. Last, you will find here 3 important slides, 35, 36, 37, they are the last one. So I will go very quickly on this slide, but I will come back next time on this slide. The first one is what to do before making operations, acquisition, deals, when you are, a company where acquisition, joint venture, debt investments are important. You need an organization preparing that. Preparing what we call the intelligence analysis. You need to be able to make valuations very quickly and also to react to potential operations, to opportunities. You need to train your teams. I remember the slides I presented you on who is in the process. You need to create what we call emergency loan capacities. It means many multiple option facilities large enough to finance all the operation. And you need also to create the ability to pay with paper. It means to pay in shares or to pay in convertible bonds or even in bonds, your acquisition. So this should be prepared for a long time and improved progressively in the financial management of the firm. During an operation, a negotiation, the problems are different. You need first to secure the team's management. It means to organize before the negotiations. And this is what I've done with 2 small teams, designing the structure, How many partial negotiation checklist? No. What about the transversal team? What about the last process when the two partners agreed on most of the points and perhaps 3, 4, 5 points are left? How it will be done? To manage conflicts? No, you have about 70 persons in a hotel for 5 or 6 days. Of course, you have conflicts. So it's a problem of human resource management. You have experts in managing that kind of point. And you have to limit all kind of risk. All kind of risk. Then, after the negotiation, we have agreed, you have signed, you need to go through what we call a no-fault post-closing procedure. It's always the same question. You have to go quick, no mistake. So you need to be prepared, trained to do that. You need to manage to organize the operational integration. It means budget mainly, reporting, and the planification system. So you have to integrate the acquired firm into your own system. What I've seen, in my experiences is that it's much easier when you buy a subsidiary of a large group, when you are already a large group, than to buy and integrate a small or medium-sized firm. Because in the large group or part of a large group, they know what is budget, they know what is a plan, which is not always very well assimilated by the teams of the medium-sized company, which is family-owned. Third, you have to take into account the company's history, culture. When you are in your own country, it's easier. But anyway, you have also traditions in different parts of countries, or traditions because of the family which owned the company. But when you move to another country, you have to be very careful. The behavior of the people, their understanding what you say could be very different. You have to control the refinancing schedule, our 3 steps here. And you have to make also a no-fault financial communication plan. That's what I try to show you, in the analysis of what's happened on the stock market. And you have also to reanalyze your core business and to develop very often a disinvestment policy to refocus on the main elements of your core business. This is what you have to do. So this is my conclusion for today. So today we managed this case. We went through Nabisco. We have underlined the main points, of the acquisition, identify the financial risk. We went through the dilution processes. We showed that the process of designing financial policy afterwards was generally done in steps and needed time. It was not done in one day, and went through very quickly a few consequences on a few points, currency allocation, for example, but also optimization of the structure of the group. And the end here is with 325 number slide on what to do before an operation, what to do during an operation, what to do after an operation. But I will explain more some elements then from these 25, 1, 2, 3 slides. So thank you very much. It is over for tonight. It's time for you to go have a rest, because you work tomorrow morning. And we will meet again next week with something different. We'll be in another industry, other problems, and we'll illustrate with our sector next week. It will be on Wednesday, the 8th of December. So good night, take care, and we'll meet again very soon. Thank you very much. Goodbye.
Thank you, Professor. Bye-bye.
Goodbye, Professor.
Bye-bye.
Guli.